Price, that's the number one technical indicator.
You do best by investing for the longer term.
If you can't explain what the business is doing, then that is a huge red flag.
Some technological change is going to put you out of business.
It really is a genuinely extraordinary situation.
Welcome back. I'm Hayden Brain, and you're listening to Opto Sessions, where we interview the top traders and investors from around the world, uncovering their secrets to success. Jesse Felder makes his second appearance on Opto Sessions, having made his debut with Ed back in October. Jesse began his professional career at Bear Stearns and later co-founded a multi-billion-dollar hedge fund headquartered in Santa Monica, California. Then in 2000, Jesse moved to Oregon, founding the Felder Report shortly after, and since his research has featured in major publications like the Wall Street Journal, Barron's, and Business Insider. Jesse and I spoke about an asset that's polarised opinion like no other, Bitcoin. Jesse presents a typically contrarian outlook for the long-term value of the cryptocurrency while recognising the speculative gains to be made now. Felder highlights intriguing investments in energy, commodities more broadly, and a potential pivot away from overvalued growth stocks towards real assets. Enjoy the episode. Welcome back to the podcast, Jesse. So how's your week been so far?
It's been great. It's been an interesting week with, rising rates is kind of playing games with the rest of the markets right now.
Yeah, it's certainly an interesting time to be a stock market investor, that's for sure. First of all, I'll get stuck into a topic that we're going to talk a little bit about throughout the course of the interview, and then we will circle back and cover a bit of your background. But for any listeners that have been with us a little while, they'll have a bit of context to who you are and what you do. But first of all, global equities have added over $7 trillion since the start of the year. And stock funds have seen unprecedented inflows. What are the key factors propping up this rampant speculation, in your opinion?
Well, I do think it comes back to, there's two things. It's really a perfect storm. I think it begins with Fed policy. When Fed lowers rates to 0%, I've heard from tons of more conservative investors about the difficulty in trying to find yield. I mean, CDs pay nothing, Treasury bills pay nothing, and so a lot of these folks that I hear from are going into the corporate bond market, and so we see spreads. Junk yields are 4% or something, and spreads are compressed to very, very low levels. And that filters through all the rest of the markets. And at the same time, we've seen the kind of the gamification of the markets through a platform like Robinhood, which allows, for example, a 20-year-old investor to last year, for example, who, was able to attain $1 million of leverage in the options market, which, an account with that, $10,000, $20,000. So there's I think the combination of free trading, the gamification of investing, leverage, and Fed policy have created a perfect storm for the speculative mania that we're witnessing right now.
Yeah, it certainly seems that way. I mean, mania is probably quite an apt word to use here. So we'll get into the detail of that in just a second. But for those listeners that missed that first interview with my co-host, Ed Gotham, back in October, can you just give us a quick précis of who you are and what you do?
Sure. Yeah, I started in finance professionally, working for Bear Stearns in the mid-'90s. I left Bear, co-founded a hedge fund in Los Angeles, was head trader, co-portfolio manager of the fund for several years before I quit the fund. And really over the last 15 years, I've just been kind of writing about the markets. And my process is really centered on, to me, one of the concepts that really had a major impact on me at an early time in my career was the margin of safety concept. And finding things that are undervalued relative to their intrinsic value, I think is, especially today, an underappreciated methodology. To me, I want to find those things that I think are trading at a discount because they, help limit your risk and enhance return, which kind of flips the idea that you have to take more risk to generate more return in the markets on its head. And so, for example, a stock I maybe spoke about last October was Bed Bath & Beyond, as a stock I've been kind of publicly talking about for, a couple of years now. Traded down to $4 or $5 a share at its lows last year, and was worth, in my view, at least 30. And like GameStop had a massive short interest, and with the improving fundamentals, it was clear that stock was going to me, was a terrific risk reward. And I didn't think it would go from 4 to 50, but those are the types of things, that's kind of what I spend my time doing, is looking for those types of opportunities.
Yeah, absolutely. And you mentioned the content you're putting out there. That's on the felderreport.com. I had a look at some of the content, obviously, in preparation for this call. And I get your email newsletter as well. So I'd certainly implore our listeners to head over there. There's some really interesting stuff in there, some of which we'll talk about during the interview. And there's some really interesting points there you picked up about your investment philosophy and kind of how contrarian, if we can use that word, and maybe we can't, it is. But as I say, we'll go into that later on. I want to return first, though, to this rampant speculation. JP Morgan measure cross-asset complacency, basing their rating on factors like valuations and price momentum. And their gauge, I think I read this article, it was a couple of days ago now, but their gauge suggests people are feeling the least fearful or complacent since the dot-com bubble. So kind of irrespective of whether we actually agree with the gauge and the validity of it and its results, are stock market investors at their most complacent right now?
Yeah, I mean, I don't understand, I don't completely how that indicator works, but from my perspective, absolutely. I do think we're seeing you can call it a lack of fear or, a risk appetite, a willingness to take risk. That is, truly something that I don't think we've ever seen before, or at least I've never seen in my career. It's when a broad swath of investors is willing to take their entire account, entire trading account, and in a lot of cases, this is their entire net worth, and put it into short-dated options that expire, in less than a week's time, and are far out of the money, call options, and literally put everything they have on a lottery ticket, essentially. To me, that is about as far as I could ever imagine risk-taking going. And we're seeing that be done in a broad way by a lot of very inexperienced investors. To me, there is no fear whatsoever out there at all.
Yeah, absolutely. I mean, to put 90%, even 100% of your investment pot on a bet like GameStop, for example, just seems kind of ludicrous at the moment. I mean, just as an aside, do you think it's a lack of education? Are you kind of fearful about the amount of uneducated or unsophisticated investors that we've got in the market at the moment?
That doesn't trouble me as much as, where they're directing their efforts. I think it's great for people to become more interested in the markets and learn. And I really do hope that a lot of these new traders will find a passion for investing and learn from these experiences they're having. But I do think what I worry most about is is not just people buying GameStop, putting 90% of their money in GameStop, but those people who put a 90 or 100% of their money into GameStop call options that expired Friday, and maybe had a $700 strike price. I mean, it sounds insane, but that's exactly what's going on. And to me, that's what I worry most about, is for those folks.
Yeah, absolutely. Okay, well, I read your recent piece on the Felder Report website, which referenced the unprecedented level of margin debt to GDP. So firstly, for those listening in, a lot of which obviously won't have read that piece, perhaps you can just briefly explain why you chose that metric, that measure, to get a sense of speculation in the market right now.
Well, I think it comes back to John Kenneth Galbraith, I think, was the originator of the quote, said that, even the most circumspect market observer has to admit that the total level of brokers' loans or margin debt, and I'm paraphrasing here, is a good indicator of the amount of speculation going on in the markets. And I think it has to be normalized in some respect. I think we're pushing $800 billion in leverage right now, which is a lot higher than it was at the peak of the dot-com mania. So you have to, potentially triple the peak leverage that was used in 2000. So, there's inflation over that time. So you got to find a way to normalize it. I use GDP because I think that's a good independent metric, and it shows leverage speculation relative to the size of the economy. A lot of people will, use margin debt to market cap, and to me, that is a faulty metric. It's as if you were going to measure, try and understand, how dangerous somebody's smoking habit was by comparing it to their body mass index. The larger the person is, you would say, okay, well, 1 pack a day cigarettes is not a big deal because you weigh 400 pounds. I think that's, what people are doing when they compare margin debt to market cap. You're basically saying because stocks are so extremely overvalued, 800 billion in margin debt matters less. And to me, I think that's a flawed way of looking at it. So I use margin debt to GDP.
Yeah, that's actually a really good analogy. That makes it quite real for me. And actually, it's probably one of the best ways to get a true sense of this trend that we're seeing in the markets at the moment. But to dig into that trend, then, can this historic level of leverage debt tell us anything about how the stock market itself is likely to perform moving forward?
Absolutely. I think, it's not just the overall level, which is that margin debt to GDP is at a record high. The previous two peaks in 2000 and 2007 were roughly at the same level. But I think we're roughly 3.5% in terms of margin debt to GDP, which is above both of those prior peaks. To me, it helps explain the incredible rally that we've seen. But when we also look at the 9-month change in margin debt, we've seen the most rapid change, growth in margin debt over a 9-month period that we've seen in decades. To me, that's astounding to be starting from a very high level of margin debt to GDP to begin with, very high amount of leverage, and then to see it surge by 60, more than 60% in a 9-month period. When you see those surges, almost every single time, it's a blow off. It signifies a blow off. We saw that kind of in 1987 prior to the crash. We saw it in 2000. We saw it in the 2007 peak. But none of those 9-month increases were as rapid as the one that we've just seen. And so I do think what margin debt to me represents is the potential for supply that could come to the markets. Everybody knows that perhaps a lot of people don't, but everybody should know that when you take on margin debt, you're at risk of getting a margin call when prices go against you.
Yeah.
And so that leverage speculation can turn into forced supply into the markets when they start to go the other direction.
Yeah, I see what you mean. So to what extent will this sort of excessive or boom in leveraged trading precede a bear market? Is that something we should expect sort of in the near term?
So I think to me, I look at margin debt as a indicator of potential risk in the market. So if that margin debt does turn into potential supply, what would that look like, right? So we have a record amount of leverage speculation going on in the markets. If that is, goes through a forced unwind, to me, it probably means we're going to see, another 40, 50, 60% decline in the stock market for, in order for that to be unwound. That's just the history of that measure, at least over the last 25 years.
Yeah, absolutely. And if this piece that I'm referencing here came with a few graphs, and one of them sort of showed the peak in leveraged debt versus stock market performance, you could see how these peaks tended to precede a bear market. So if we're using sort of historical performance as an indication of where the stock market's headed, do you think that's around the corner? Is this something we should expect in the short term, medium term, or not?
I do think that typically the type of blow off we're seeing right now suggests you're in the final months of a blow-off phase, so that, a reversal could happen. To me, there are other indicators to look at that would help confirm the idea that a reversal is imminent.
Yeah.
But just looking at margin debt alone, this type of a surge usually suggests that there's a peak probably probable within the next few months. The other thing that I'll say is it's not as close of a relationship, hasn't worked as well. But when you take that margin debt to GDP metric, and this is also another reason why I look at it, and you compare it to 3-year returns going forward, it shows you potential for risk. And like I said, at those prior two peaks, when we got close to 3% to margin debt to GDP, we had 50% declines in the stock market. So this would suggest that, the potential for a decline, or the potential depth of a decline, could be at least on par with those two bear markets.
Yeah. Okay, I see. Yeah, and completely appreciate it's sort of one piece of the puzzle, but certainly piques my interest and should encourage people to kind of look further into this idea that a bear market could be around the corner, because at least on the retail side of things, it certainly seems that that's not at the top of people's agenda and not something that many of them are considering at the moment. So really fascinating thoughts there. So thanks for sharing that. And I want to turn to your sort of philosophy now, and I guess your investment strategy more broadly, before we have a look at current markets and some potential opportunities there. Your website's tagline is "taking the financial road less traveled." It was an interesting sort of phrase and sentence. So firstly, can you just explain what you mean by that?
Yeah, I think generally what I'm trying to do is, avoid the most popular investments or even strategies in the markets, because to me, one of the most dangerous dynamics in the markets is crowding. Whenever you see crowding, it can be problematic, whether it's short volatility a few years ago, which blew up in 2018, or these options trades that we're seeing today, which I do believe contributed to the crash we saw in March. And when they're unwound, could potentially be as dynamic as that vol implosion was in 2018. So it's really about avoiding crowding and looking for those areas of opportunity that are ignored. And I guess maybe the best way to think about that in terms of recent history is a lot of the opportunities I'm finding in the markets have been created by the popularity of passive investing. So things that aren't well represented in the indexes have become terrific opportunities, very recently. And so I think that, probably helps to explain that tagline.
Okay, yeah, interesting. So actually the rise in passive investing has helped you to identify more opportunities that I guess are contrarian to the majority of flows, because as we know, the majority of flows go into sort of indexes and things like that. So is that a trend that you've experienced over kind of in recent time, over the past few years?
Yeah, absolutely. And I think it was, 20 years ago or something, maybe longer. Maybe it was 30 years ago. One of my favorite Warren Buffett quotes, he said that, what better advantage could a true investor have than to have, a big majority of the investing population be trained that research is a waste of time. And, he said this 25, 30 years ago. And today, passive investing is so much more popular than it was when he said that I do think there's an incredible opportunity today, just due to the sheer fact that the vast majority of investors have given up on doing any research at all. It creates opportunity for those of us who believe in the value of research. Yeah,
absolutely. And to what extent then are you? So you're looking at areas of the market that are less explored and not going to necessarily be picked up by the sort of the massive passive funds. But to what extent are you looking for sort of mispriced or misvalued opportunities? Does that come into it?
Absolutely. I mean, I think probably the last time I was on an Opto Sessions interview. I spoke about the opportunity in energy. And to me, this is probably representative of what I'm trying to do, because you look at what's most, it's not only passive investing that's become very popular in recent years, even more so. I think you look at the flows that have gone into ESG funds in the past 2-3 years, and that's been the area within passive that's become, very, very popular, kind of the focus of investors' attention. Yeah. And so energy was already, fell to 2% of the S&P 500 index, the smallest share in the history of that index. And I think a big part of that is, money flows into ESG, which is very, very well intentioned. I absolutely understand the intention, but they have no exposure to energy, and that essentially creates forced selling of all these energy stocks to the point where last October, last time I spoke to you guys about the energy opportunity, all of these stocks were trading as if they were all going to go bankrupt, and that we were not going to use oil ever again, and that we were all going to switch to 100% EVs within the next couple of years. And now the oil price is over $60 a barrel, and what's going on in Texas is creating, exacerbating what could be the early stages of an energy crisis, and the energy stocks are soaring, and so all of these passive investors who have no exposure, and especially ESG have no exposure, have missed what I've seen as just a terrific opportunity.
Yeah, absolutely. And I want to get into energy and sort of explore that opportunity in a little bit more detail in just a second, because I think, as you say, that story's progressed since the interview in October, and maybe even the investment case has actually strengthened since then. But just to finish on your philosophy, I mean, we've talked about kind of where you're looking in the markets, and it's not simply just looking where someone else isn't looking. I think there's probably an element here that we haven't discussed, which is timing. I mean, I said I got your newsletter, and I had a look back. I think the first sort of welcome message you get, you have a quote at the top by Jim Grant, which reads, "The key to successful investing is having everyone agree with you later." The emphasis on later. So does that suggest then that timing is imperative for successful contrarian positions?
Absolutely. I think, the best time to enter a position is when it's most hated. And to me, when ExxonMobil was kicked out of the Dow Jones Industrial Average last year, that was pretty representative of the hate towards energy. And, I use other tools to try and that are helpful with timing. I don't consider myself necessarily a value investor. I think value's kind of been bastardized by a lot of the systematic type of investors. But so I'll use technical analysis and momentum analysis too, that I think help with understanding what in terms of timing. I mean, very simply, momentum to me has been something that I've studied for 15 plus years. When you overlay that onto a contrarian framework, it can be, to me, was the missing piece of the puzzle. So, finding things that are hated, out of favor, but are, don't have strong downside momentum, to me, that comment and a potential for reversal in momentum are the types of things that I'm looking for.
Okay. Yeah. I hadn't appreciated sort of the momentum aspect. So that's the factor you're looking for to give you the sort of signal, the insight to actually go and make the trade and take a position.
Yeah, absolutely. I mean, I think if you look at, the energy stocks as a good example, last year, ExxonMobil was, kicked out of the Dow, and the stock was, to me, that was peak hate for the stock back at the end of October, right around Halloween, was, I think, the timing of that. But the stock didn't make a new low, right? It didn't break below its March lows. And so to me, that's a good example of it holding support technically. And so downside momentum was dramatically less in October than it was in March. Downside momentum was very strong in March, however you want to measure it, based on RSI or any other kinds of measures. And so to me, it was peak hate, but technically momentum was suggesting that, a lot of the selling that had been done in the stock had already been done prior, probably back in the spring. And there wasn't enough selling pressure and momentum to push to new lows, which was a positive sign technically.
Yeah. Okay. That's great. That makes a lot of sense. So I guess now we've got a little bit more context around your sort of investment philosophy. I want to move us on to sort of current opportunities. The first one, we've touched on it already, is energy. You discussed this sector during your first interview with Ed back at the end of October. So the story's progressed since then, with both JP Morgan and Goldman Sachs calling a new super cycle in oil earlier this week, I think. So from an investment perspective, have people been too quick to shift their focus away from oil and onto renewables?
Absolutely. I do think there's a bubble in renewables, and especially in the electric vehicle segment. The prices of these stocks, every investor is hoping to find the next Tesla, and Tesla is obscenely overvalued right now itself. So I think, the traditional oil and gas energy sector is the flip side. As my friend Diego Perillo would call it, it's the anti-bubble to the bubble in the rest of the market. As I said, these stocks, to me, back in the fall, were trading at a small fraction of their intrinsic value, even if the oil price weren't to go on to a new super cycle. Now, if the oil price does what I think is possibly could do, we have supplies here that are dramatically reduced, and demand set to pick up significantly in the second half of the year. It could lead to an energy crisis, to where we see oil back at $100 a barrel pretty quickly. If that's the case, then these stocks are still.
Yeah, I read an FT piece before the call that also suggests that actually the price per barrel could exceed $100. So it's interesting that you see that could reach that level kind of moving forward, which is obviously a massive shift away from where it is currently. So a potentially really sort of interesting opportunity there for people to look out for. So are you invested in any oil sort of producers or oil, just the commodity at the moment? Have you got any active positions in that space?
I do. And, they are all short-term overbought and technically kind of running into some short-term resistance levels. But I do like the oil and gas producers as a group, as a segment out of all those areas. I also like the infrastructure plays too. In fact, I think those maybe still have some good short-term upside ahead. The yield differential between a lot of these infrastructure stocks and other fixed income asset classes is still far too wide. And that's still investors pricing in this the death of the oil and gas sector. So those are the sectors I like. I think in the short run, because the broader market is maybe vulnerable to a reversal, that these stocks could correct from here. But I do think I want to be buying the dips in the energy sector over the next several months.
We hope you're enjoying the episode. For interviews like this every Thursday, subscribe wherever you get your podcasts. And while you're there, make sure you give us a star rating and leave guest suggestions along with any other feedback in the review section. Now, back to the show.
Okay, yeah, interesting. And when we reach this point that obviously we will inevitably get to, I suppose, where oil is no longer our primary energy source and renewables do sort of supplant oil as the key energy source. I mean, it may be an obvious question, but I'll ask it anyway. What happens to the price of oil then? I mean, is it as simple as saying it'll collapse without the demand that we have for it now, or kind of how does that play out? It's such a big market sort of around the world. I was just interested to get your thoughts on that.
Yeah, I think that's going to be decades in the future, and I think people don't appreciate that. I think
that's true.
Within the next 10 years, we're not going to use oil anymore, and that's absolutely unrealistic. I think the other thing people forget is the more capital that goes into an industry, the worse prices are going forward, right? It's simple supply and demand. You have massive, I mean, we saw it in the oil price, right? You had so much capital. The Fed lowers rates to 0% in 2009-10. The oil and gas, fracking companies can borrow money for nothing. They invest in, massive exploration and production in the United States, and the oil price crashes a few years later. And so now today we've seen so much production come offline, and we see literally no interest at all, even from oil companies, to invest in exploration and production. To me, that is very, very supportive of the prices going forward. And all the capital today that's going into alternatives and into EVs and all these things is going to depress returns in that sector for a long time to come.
Yeah, absolutely. I think it's almost a symptom of stock market investors and participants to look forward without even realizing they're looking forward, and actually sort of pricing in stuff that, as you say, is decades down the line. So interesting to sort of retain a bit of perspective and context on that energy story. And kind of whilst we're on commodities, a brief tangent, but loosely related, given that we were just talking about oil there. I saw a tweet on your Twitter feed yesterday. It read, "It is rare in macro forecasting when the stars align so perfect. The combination of inflation risks, capital scarcity, and 50 years of underperformance make commodities one of the most compelling long-term investment opportunities at the moment." So I just say, I mean, obviously a kind of line like that sticks out. And I just wanted to get quickly your thoughts on kind of commodities in general and how excited you are about the opportunity in that space at the moment.
Yeah, that came from a recent report from my friend Jonathan Tepper's firm, Variant Perception, and I really value their work. But I do think, and I've been writing for the last couple of years at least. Well, really, I mean, I turned strongly bullish on gold back in the summer of 2015, a little too early, but I think the performance in the gold price has, and I wrote about this last year just in a blog post, is pointing to the fact that we're potentially seeing a paradigm shift away from financial assets and toward real assets. And there's a lot of macro reasons to believe this too. Over the next 5-10 years or longer, I think you look at the chart in that tweet was essentially the value of commodities relative to, I think it was the stock market. And commodities are incredibly cheap relative to financial assets. They have been for a few years. And you combine that with the macro backdrop, and I do think commodities and more broadly, real assets are going to be the best performers. They're going to dramatically outperform financial assets over the next 5-10 years.
Okay, great. Yeah, I was going to ask you for a time horizon on that. So you expect this sort of trend to play out over the next 5 to 10 years?
Or longer. I mean, I think we're in the middle of it. The gold price bottomed in late 15 and has been, trending higher since. There's a huge gap now between it and the CRB index, commodities index, which tells me, yeah, commodities are short-term overbought. They could experience a correction, but this gap is probably going to close. Commodities probably have a very bright future over the next several years.
Okay, yeah, interesting. So another sort of sector of the market for our listeners to look out for. I'll link that Variant Perception article in the episode description. I read some of it myself before the call, so definitely kind of highlight it as an interesting read for those listening in. I'll also link the article that we talked about at the top of the piece, your piece on rampant speculation. I think that's definitely an interesting one for our listeners to get their head around as well. So finally, I wanted to bring up sort of a third area of the market that I guess has been talked about a lot in the media, and actually it's hard to pick another asset that sort of polarizes opinion more than this, and it's Bitcoin. So Bitcoin's value is essentially based on the fact that its supply is finite. I think 21 million is the number that people tend to trot out. But I read a piece by you that was published towards the start of the year, I think, that discussed the multiplying number or type of Bitcoins now in circulation. So we've got Bitcoin Cash, Bitcoin SV, those would be two iterations on the theme. So do you think those sorts of iterations, that increase in circulation of different types of Bitcoin in any way undermines the value of Bitcoin at all?
Yeah, I do believe that. I don't believe the premise that Bitcoin is truly limited in supply. I think, for example, it's my understanding that Dogecoin is identical to Bitcoin. Just was created, as a joke, but it has the same, exact technical specifications as Bitcoin does. And so to me, that's, emblematic of the fact that anybody can go create their own version of Bitcoin at any time. And that's just not true for things that are truly limited in supply. And in the article, I even point out that, Bitcoin is forked several times through its history, I think at least 4 times. And every time that happens, that in my mind, it doubles the supply of Bitcoin. So whether it's original Bitcoin and then Bitcoin Cash or Bitcoin Gold splitting off from Bitcoin, that essentially, in my mind, doubles the amount of Bitcoin in circulation. So, yes, there are only ever going to be 21 million original Bitcoins created, but anybody can go create cryptocurrency at the drop of a hat. And to me, that is, argues against the idea that it's truly limited in supply. I think Bitcoin might be terrific as a speculative vehicle, right? I think that, and I called it a trading sardine, which, relates back to a story, a famous, Wall Street story, the difference between eating sardines and trading sardines. and I think Bitcoin is a trading sardine. And, in that it is a great vehicle. And I think that's exactly how Paul Tudor Jones and Stan Druckenmiller and those guys are looking at it. They're looking at it as a speculation. They don't see it as an investment. They see it as something that, so long as other investors are believe the story and are buying it and pushing prices higher, then the trend and momentum's in its favor. Why not speculate on even higher prices? So I'm not necessarily, bullish or bearish on it. It's just, it's not something that I see as a valid investment.
Yeah, I see what you mean. And that's exactly why I asked the question, because having read the piece, it felt like there was a more sort of nuanced view to pull out there. So yeah, it's sort of fascinating to get your thoughts on that. And actually, I guess at one point on kind of the more bullish side of the longevity and kind of the investment case, and I am talking in sort of investments here for Bitcoin, is that a lot of people are presuming at some point that one of these coins will win out. So Bitcoin is vastly more popular than Bitcoin Cash or SV and the other iterations and the other coins, Ethereum and all these sorts of things. And therefore, does it on that basis have longevity in terms of a store of value, in your opinion? Or do you not see that ever happening? Do you not see the whole market getting behind one coin, one iteration?
I see that's a possibility, but I think it would be against the odds for Bitcoin to become a true global currency. I'll just say that I think somebody replied to my piece, with kind of a tongue-in-cheek kind of joke saying, I guess with an analogy, they said that, these newfangled automobiles will never catch on, said the horse buggy salesman. And, I understand that, but to me, it was very ironic because back, 100 years ago, there was an automobile bubble, right? I mean, there were hundreds and hundreds and hundreds of car companies, and the vast majority of them went out of business. And so to me, the lack of awareness that, automobiles, he was joking that, when the automobile came out, people said it was a bubble, and clearly automobiles have become, integral to society. But automobiles were a bubble when they came out. And so I do think there is a cryptocurrency bubble right now to try and pick which company is going to be the Ford Motors, the GM, is probably impossible to do. I do think the real risk to Bitcoin is that governments, and namely the U.S. government, decides it's too big of a risk, and they create their own fiat cryptocurrency and essentially outlaw Bitcoin. There's a lot of reasons for them to do that, and so I think that is a major risk that is vastly underappreciated by Bitcoin aficionados.
Yeah, I completely see what you mean. And just to pick up on your point, I think you mentioned sort of a few hedge fund managers there, sort of institutional acceptance or adoption of Bitcoin and cryptocurrencies more generally seems to be, well, I guess the penultimate piece in the puzzle. And you referenced the final piece in the puzzle there, which is of course sort of governmental acceptance. Two very big hurdles, but it does seem that at least that third or penultimate hurdle is been kind of surpassed at the moment, I guess, in the sense that BNY Mellon, for example, the oldest bank in the US, are storing and managing Bitcoins on behalf of clients. But I'm getting a sense for you that yes, they are doing that, but it's not because of any real sort of acceptance of this as a kind of store of value in the long term. And the long term, I guess I mean sort of decades and multi-decade sort of time horizons here, but more because, it's a speculation. It's a speculative bet based on a swell in sort of retail demand, I suppose. Would that be fair?
Absolutely. I do think, my friend Grant Williams put out a terrific podcast recently, an interview with Tony Deaton, and who makes a very important distinction between his own investment practice and Wall Street, which is largely comprised of investment businesses. And so the difference between a practice and a business is a practice, says I'm going to do what I believe is right for my clients, my patients, however you want to look at it. A business says I'm just going to give people what they want, right? Not necessarily what they need or what they should have. And Wall Street is, there's a long history of Wall Street giving people what they want in order to profit from that, rather than giving people what they need. And I think see that time and time again. And Wall Street just looking for a way to profit from natural demand. And so I think that's probably what's going on here is Wall Street doesn't necessarily, these banking systems don't necessarily believe in the Bitcoin premise. They just want a way to profit from it. Like they say in a gold rush, most of the money is made from selling picks and shovels, not from actually discovering gold.
Yeah. Okay. Yeah, that's really interesting. Okay. Well, I'll leave Bitcoin there. And actually, I don't want to take up too much of your time, but we've probably got a couple of minutes before I move us on to our quickfire question round to finish the interview. So perhaps I can ask, we've talked about a few interesting opportunities there: Bitcoin, commodities, energy. Is there one that we haven't discussed at the moment, an area of the market that you're particularly bullish on, perhaps that many other market participants aren't considering right now?
Well, right at the very top of the interview, I mentioned interest rates, and I do think, there are, to steal Diego's phrase again, there are some anti-bubbles in the markets right now that are still very attractive. I do think one of them is the gold price, which is the flip side of the bubble in cryptocurrencies. I think, gold prices have been hurt by rising real interest rates over the past 6 months. And that's, to me, a function of interest rates rising faster than inflation. But I do think over the next, and there's a risk gold could trade lower over the next month or so. But I do think from several months from now, we're going to look back and see that inflation's probably rising faster than interest rates, which will shift that real rates from being a headwind for the gold price to being a tailwind. By the same token, rising interest rates, by the way I figure it, growth stocks have essentially risen so far due to a lot of the speculation that they're essentially priced in negative interest rates. And so with interest rates rising now, to me, I think that makes growth stocks particularly vulnerable. And, so I do think, to me, what's going on in rates is the most interesting thing. And it does create opportunities. I think, like I said, the gold price is an interesting one. I think there's an opportunity right here to be adding gold on weakness and to be maybe avoiding shifting out of growth stocks right now.
Yeah, so shifting out of growth stocks and pivoting into value stocks, or not?
Well, yeah, I mean, I kind of hinted. I don't really like value as a factor. To me, if you adhere to Ben Graham's philosophy, you can't really invest. Value investing has to be done through individual security analysis. So it's not just as simple as finding something that's a cheap price to book value, price to cash flow. The analysis requires more than that. So yeah, I think pivoting out of growth stocks into real assets generally is probably a smart thing to do right now.
Yeah, okay. Real assets, that's the key takeaway. Okay, nice. That's the perfect place to sort of end the main body of the interview. And I'll go over to now our quickfire question round. So this is something we ask all of our guests, simply a lighthearted way to end the episode. And feel free to keep your answers short. One sentence, one word is absolutely fine. First question. In your opinion, what is the top mistake investors make?
Recency bias. I think we have a tendency to take recent history and extrapolate it indefinitely into the future, and that is regularly a major mistake people make.
Yeah, that's a really interesting point, actually, and I won't spend too long on it, but I guess something that's sort of emphasizing that and encouraging that recency bias is the amount of media that we get, whether it's newsletters, online articles, videos on YouTube, social media, etc. That almost exacerbates that recency bias. Is that sort of a fair assessment?
Absolutely. And as my friend Peter Atwater likes to say, media reflects mood. And so the media can be a terrific sentiment signal for understanding, how to, when contrarian opportunities present themselves.
Okay, great. So question 2 then, where do you go for investment or economic insights? Do you read specific publishers, for example?
I mentioned, Variant Perception. I do read their work and value it. For me, my most valuable network or resource is those that I follow on Twitter. I follow a little over 100 accounts, and it's everyone from value investors like myself to technicians to macro investors. And that network to me is very valuable.
Yeah. Okay, great. So third question, what is the most memorable moment from your career to date?
Most memorable moment from my career. I mentioned recency bias. So I think it's going to be recent history. Obviously, there are things I've had. I think it's my losses. I've had major losses, and I think everybody who learns anything in the markets, we all learn more from mistakes than anything else. And so, I've had some major mistakes in my career. Those are the things that stick with me, and I consciously remind myself of those things so that I try not to make those mistakes over and over again.
Yeah, true. And I don't want to sort of I don't want to ask if you're not willing to share, but are there any particular losses or bets that didn't come off that particularly stung?
Absolutely. Several years ago, I was putting on a big position in Corinthian College as a for-profit kind of blue collar career college, and it was, I think, shortly after Obama took office, and his administration decided to put a lot of those companies out of business, and I didn't appreciate that risk near enough, and that was a big loser for me. And so it's something I remind myself of regularly, that there are risks that you just can't see, and so you have to have to be aware of that.
Yeah, absolutely. Yeah, sorry to revisit that, but it's always fascinating to hear about people's losses. So the final question then, what is an investor's best source of alpha? So if you had to narrow it down to one thing, where do you think the great investors derive their outperformance?
I think it comes from being willing to step into the most hated asset class, most hated stock, most hated security in the market. To me, when something is really, really out of favor, it's usually priced such that when that sentiment subsides, people don't even need to get positive on it. They just need to hate it less, and you can make a great deal of money. And so I ask myself regularly, what's the most hated asset class right now? What's the most hated stock in the market? Because that's, to me, where I find the greatest opportunity.
Yeah. Okay, great. Well, yeah, I think that's a really fascinating takeaway and a very different way to look at the markets than some of our listeners would have previously anticipated. So I'll leave it there. All that's left for me to say is thank you very much for coming on the podcast, Jesse. It's been a real pleasure.
That was a lot of fun. Thanks for having me. I appreciate it.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest. Opto Updates is our short newsletter sent every day during the trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends, and in addition, we'll also keep you notified of any new products, stock reports, or webinars from the Opto world. If you're interested, sign up using the link in the show notes. And thanks also to Co-Fruition for consulting on and producing the show. Until next time.